Hello guys, welcome back to the EliteTraders Academy video series where we take you from zero to hero. In this video, we're going to get a little bit more interesting. Now we're going to start actually looking at some charts and breaking down how you can begin to read them. So as you can see on the screen, we're going to first discuss what a forex chart is. Now, a lot of the principles I'll show you in this video can be applied to other assets such as stocks, crypto, commodities, and obviously in this case, forex. So every chart will give us a visual representation of price movement over that specific period that you have selected. So each candle will be a representation of one time period. So if we're on the 15-minute chart, that one candle on that chart will represent 15 minutes of price action of buying and selling in the market. So we can use this to develop an idea of, are buyers taking control? Are sellers taking control? What is the momentum like in the market? And this is your key tool actually for getting into a trade and out of a trade on a technical basis. So these candlesticks, we will cover the anatomy, so like we're in science class dissecting a frog or something. Sorry for any vegans or pacifists. So the anatomy of a candlestick is very, very simple. We've got two. We've got a bullish candlestick and a bearish candlestick. And actually, sometimes we have basically no candlestick where price opens and then closes back on the open. It doesn't happen that often, but we don't need to worry about that in this video. So a candlestick will contain four things. We will have the high, the open, the close, and the low. So this red one here, and when you open TradingView for the first time, or a lot of standard themes on a trading chart will be red and green, just to make it easy. So a red candlestick is bearish, a green candlestick is bullish. Obviously you can change this, and most people do change their chart colors. So the way we determine a bearish candle is if the close is below the open. So in this case, we can see that the candlestick opened here. It then closed below the open, telling us that the candle opened, sellers pushed the candle down, and it closed there. So it's bearish because sellers have taken over. And then it's the opposite case for a bullish candlestick. As you can see here, we have the open down here, and buyers push this candle up to close here, causing a bullish candlestick. So that gives us the high and the low left. So if the candle opened and closed here, what the heck are these highs and lows? Well, these are what we call wicks. So this isn't the body candle. So what we call the body is this middle bit. So the close and the open is considered the body. The bits on the top and bottom are called the wicks. So this is where, while that candle was still open, so it opened here, it might have pushed all the way down here, and then buyers came back in and pushed it up, and then it closed here. And that gives us this period here where we've got the wick. So this can indicate, depending on the length of the wick and certain styles of the candlestick, we can start using the wicks to say, okay, maybe buyers are running out of strength or sellers are running out of strength. We'll go into that slightly later on. But that's sort of the general rule of following what candlesticks are doing. From the way I trade, and again, this video will eventually, this series will eventually evolve into showing you my exact strategy, what I look at, how I do it, how I implement it, everything. And you will eventually start to notice I actually don't pay attention to candlesticks very much. I'll pay attention to the current candlestick, and that's pretty much it. I don't really care what 5 candlesticks ago happened. I don't care what that candle looks like, if that makes sense. So the next key thing about trading is time frames. This is very important because what you don't want to do is sit on the weekly time frame and say there's a trend here, or there's a certain candlestick here, then go down to the 1-minute chart trying to trade what you saw in the weekly. That just would not make sense. So in order for you to really find your style, you have to understand the time frames and the differences. So for example, on the screen, you can see each candlestick, we actually spoke about this slightly before, each candlestick is a measurement of that time. So if we go onto the 15-minute time frame, each candle represents 15 minutes of price action. So we would use sort of the 1, the 5, the 15 minutes, even the 30-minute time frame for intraday trades. So that means you would be holding a trade for 1, maybe 2 days, and that's about it. For a swing trade, you might be looking more towards the 1 hour to the 4 hour time frames. And that's a swing trade is where we're looking to hold a trade maybe from 3 to 4 days up to a couple of weeks, maybe 1 to 2 weeks. And then the daily and the weekly are meant for long-term structure along with longer term trades. So more of a long swing trade, which could be up to maybe 4 or 5 weeks, or even a position trade, which could last maybe a full year. So as you can see here, higher time frames give us stronger signals. Now we'll go into that slightly I think it's the next slide actually, or the next 1 or 2 slides, we'll go into some structure. But the higher the time frame, the easier it is to trade, generally speaking. And we should be mixing time frames for multiple confluences. So just to quickly touch on this, what I mean is when we want to use multiple time frames for context, you don't want to sit on the 5-minute time frame and just try and trade that, because you're missing so much context behind the market. You maybe want to start on the weekly time frame and say, okay, for the past 2 weeks, sellers have been in control of this market. Then go on to the daily time frame and say, oh, today buyers have been in control. But if buyers are in control today, but the last 2 weeks, sellers have been in control, maybe buyers will lose control later today. So you could go into maybe the half an hour or the 30-minute time frame, start looking for sell setups, or maybe look into buying the buyer's bar today. There's lots of ways to do it, but the main thing I'm trying to get at here is using the different time frames to give yourself context behind what's actually going on in the market. So that leads me into the next thing, which is price movement and structure. So if you are new, and I was just saying the past 2 weeks have been sellers, you probably didn't really be able to visualize what that actually means, but this is what it means. So an uptrend and a downtrend are very, very common terms, or a bullish market and a bearish market. You will hear that lingo all the time within the trading space, and it's very, very simple to understand. So an uptrend or a bullish trend is when we have buyers in control. So the market is moving up, so we have a low. We come up, we create a higher high. Then we come back down and create a higher low. So this higher low is very self-explanatory. Obviously, this is a new low, but it's still higher than the previous low. But it's still a low because it's lower than the high. I know it's a little bit confusing, but it should make sense as we go on and as you start getting a little bit more hands-on with the markets. So we've created the higher high, a higher low. We come up and make a new higher high because this is higher than the previous high. We've got a higher low because it's higher than the previous low. And this is how we gauge an uptrend. And then we just do the exact opposite for a downtrend, which is here, or a bearish trend. So we've got the high, we come down, create the lower low. Remember, we've got a lower low here, and then we create the lower high. And the lower high is why? Well, it's because we've created this lower high relative to the previous high. And again, a lower low because it's lower than the previous low. Lower high, again, lower than the previous high. And then it can continue forever in theory. But you should get the idea now. Now, just while we're discussing this is very, very important, and you will want to take this away with you, is a big problem with retail traders, especially new retail traders, is they will see something like this where the market is just running up, it's doing very, very well, buyers are clearly making a lot of money. They will try and sell. They will see, the second higher high and be like, oh, the market can't go higher. Surely it can't go higher, and they'll sell and they'll sell and they'll sell. And they'll just lose because they're selling into a trend and they don't know why that trend is occurring. Now, obviously, the why behind the trend is something we'll go over in later episodes when it comes to economics and central banks. But yeah, don't be the guy that's trying to counter trend trades and catch the highs and lows of counter trades, because trust me, from my experience and from a lot of traders' experiences, trying to do that is so much more difficult than just following the market. If you see the market doing this, going higher high, higher low, higher high, look to buy into it. Don't try and sell it unless you've got a very, very, very strong reason. Saying the market's too low or it's too high, it's not good enough and you will lose money. Having said that, these trends, especially in forex, 90% of the time will reverse. But again, I'm not saying that's something you should try and time. So when I say 90% of the time they reverse, I'm saying that because we're trading G10 currencies and their economies generally bounce back very well. So if you're looking on the weekly time frame, the daily time frame, you will likely be able to see places where, okay, it's possible it will reverse here. But again, for a new trader, trying to do that is a death sentence. Please do not do it. And that brings us really nicely into the next topic, which is support and resistance. This is the bread and butter of trading. A large amount of trading strategies derive from a very basic concept, which is support and resistance. Now, these are very, very easy to understand. This, again, it's the bread and butter. It's trading 101. It's very, very easy. So the resistance, you should think of this like a roof. Like when you're in your room now or your office, wherever you're watching this, you shouldn't be able to just, reach through the top of your roof. It shouldn't work like that. Obviously, your roof should be solid, it should be hard, and it should be, maybe take a hammer or a chisel to be able to break through it. Same thing with the support. That's the floor. You shouldn't be able to just walk straight through the floor. If you can, get a new house. But yeah, it should take some, real pressure to get, break through the floor. It's the same concept with support and resistance. So the support is the floor, the resistance is the roof. So if we see something like this, which is a ranging market, so actually we didn't speak about this earlier. So we've got the uptrend and the downtrend. That's sort of the two main directions of the market, but we do get another one, which is this, which is a ranging market where we just see essentially sideways. So we're creating highs and lows, but it's not going necessarily up or down in a trend. It's just sideways essentially. So we can use these supports and resistances for multiple things. So we could sell off the resistance, we can buy off the supports, or we can wait for a break of the support and resistance. So if we see a break lower of the support, that tells us that there's a lot of sellers in the market putting a lot of pressure into the price, so we could possibly jump into that and sell with them on that break. Same thing on the resistance. If we see a break higher, it means buyers are in control. We could probably jump into a buy and just ride off their momentum. Now, obviously, that's not a strategy. That's just the sort of the theory behind support and resistance. I'm not telling you to go and do that, but these are great psychological levels. So as we spoke about earlier in this presentation, the markets are sort of big on psychology, and the higher the time frame, the better the signal, and that's exactly this. So if we see this on the 1 minute chart or the 5 minute chart, it's pretty meaningless. You might see some sort of reaction, but it's not something I would base a trade on. But if we saw this on the monthly, the weekly, the daily time frames, that's a large amount of people looking at that same level. And that means there's a lot of money pushing price from resistance. There's a lot of money pushing price from support. So it holds a lot more relevance. And again, there'll be more people looking at that level. There'll be a psychological effect. It's like a sheep mentality. It's like, I think you're going to buy off support. You think that guy's going to buy off support. You think she's going to buy off support. I'm going to buy off support because I think all of you are going to buy off support. And obviously vice versa, resistance. I might sell because I think you're going to sell. You might sell because he's selling or she's selling. It's the same thing. Now, obviously, this is not accounting for economics and market drivers. This is just the pure sort of technical reaction and theory behind this so far. Chart types. We've got 3 main ones, but there's so many different chart types you can use. I use primarily a candlestick chart and an area chart. The 3 main ones are candlestick, a bar chart, and a line chart. They're not that different. They're just slightly different ways of reading the same information. So, if you don't like the way a candlestick looks, you could maybe go and look at bar charts or Heikin-Ashi and look for a strategy that revolves around those things. So line charts and area charts are primarily used for longer term traders. So if you look at someone on a trading floor, or you see a film about trading or something, sort of visualizing a trader on media, you'll generally see them using a line chart or an area chart. And it's not wrong, because when you're looking for a long-term trade, you don't really care what the candlesticks are doing right now, because you will have built a long-term thesis based on macroeconomics or future projections or whatever it may be, or earnings. So you're looking more just for the general direction and general structure of the market, not to see, the micro movements of candlesticks. Candlesticks are more common for technical analysis. So for retail traders like me and you, candlesticks do come in very handy, because we do like to typically see the micro movements of where wicks are forming, how certain candles may have closed prior to a different candle, etc., etc. Bar charts, as you can see, are less used in FX. Actually, I don't know anyone that uses bar charts, but I do know there are strategies that revolve around them. So let's go and have a look at some charts. So here we go. So this is the dollar index. Now, my chart will look slightly different. So let me just reset this to default so we can see it quite easily. Here we go. So we spoke about obviously chart themes in the previous video, so I'm not going to go into that now. It's not something we need to concern ourselves with. We're going to pay more attention to the candlesticks we spoke about. So, as I said, bearish candlesticks typically are red. A bullish candlestick is green. Now this here, let me just draw a box around it so you can see it a bit more clearly. So here we can see great examples of candles. So we can see this red candle, the bearish one, clearly opened here and closed down here, giving us that red bearish candle. But then we have these candles, which obviously aren't as simple as the example I showed you. These ones look a little bit strange. Now, you should remember, I was saying that we can use wicks to start determining the direction, or we can start using wicks to help us gauge the markets. So here is a great example. We saw wicks to the upside, telling us that buyers were coming into the market, but sellers were taking back control, pushing this candle down, giving us this bearish candle. Then we can see again here, we actually had some bullish candles. So we can see the bulls or buyers took over at this point and pushed this candle all the way up to here. But the critical thing about this candle is it didn't maintain it. So sellers came back in, pushed this candle all the way back down, and buyers left with just this small body here. The same thing happened on the next candle right here. Buyers couldn't maintain or sustain a move. Sellers took control again. And then eventually we continued to sell off to the downside. So candlesticks can tell us a lot about the psychology of the market right now, and obviously previously as well. So we can see here, a wick to the downside. Buyers came in and took control, giving us this really strong bullish candle. We came down again to this previous low, and this is actually starting to get a little bit more into the structure side. So we can see we had a support here. Price came back into this support, and sellers came back into the support. Buyers took control, pushing price back up, and then the market continues to the upside. Now, that was a good example of very simple support, but things can get a little bit more complex. So if we go out to the monthly chart here, you can see my analysis is already drawn up. So I want you to pause the video or just wait a second while I have a drink. I just want you to look at it and see if you can understand what's going on. Okay, so what do we have? Well, we've got a few things going on. So this orange line is a trend line. We've not discussed trend lines yet, and trend lines are not great in my opinion. I will draw them in certain situations where there is an obvious one, like this. The problem is with technical analysis, you will come to learn, it's very discretional and very personal, really. So the way I draw a trend line might be different to you. So you might have drawn a trend line like this. Do you see what I'm saying? So it's the same thing. It's still a trend line and it's still valid, but you've just drawn it slightly differently. That gives you a different outlook now on the market. So always keep that in mind with technical analysis. Never be trying to break down every single movement, every single candlestick, because first of all, it's not going to work. That's not how technical analysis does work. And second of all, just because you view it that way, it doesn't mean everyone else is seeing the same thing and trading off the same thing. So if you're going for a buy because of something, it doesn't mean the market's going to go up, because obviously for the market to go up, other people have to be seeing the same thing, have the same idea, and jump in as well, pushing the market. So anyway, let's get back to structure. So what we've got here is two things in one. We've got a resistance turned support. Now, this is a very, very common thing to happen in the market. So we've got very clear resistance. So buyers pushed into this level, sellers took control. Buyers pushed in, sellers took control. Buyers almost broke above, but sellers took over again. Same thing here and again here. Finally, buyers took over this market and we broke above, and now sellers are taking control again and we're coming back down and testing the support. So what does that show us? Well, it shows us when we're below this level, sellers enjoy taking over, and we can often see price come back down to this level. When we're above, we can actually start seeing price come slightly higher, possibly back to this previous high, and we can start breaking down the markets into sort of segments, if you will. Now we've got the same thing here, resistance turns support into support. So you can see how simple it is, because all we're looking for is where has price been previously and where has it been rejected? Where has it been multiple times? So this on its own, this high wouldn't be a resistance. It turns into a resistance once we reject a second time, because that tells us that sellers are not wanting to come higher than here. So that's pretty much it for support and resistance. It's very, very simple. As I was saying, it's the bread and butter of trading. Now, it might take you a while to be able to sort of identify these things quickly. I can sort of look at a chart and say, okay, there's support here, resistance there, it looks like this there. But that's because I've been trading for a long time. I've been looking at the markets for years. It's very quick. But for you, it might take a little bit longer, and that's completely fine. But don't overthink it. If it's not super obvious, it's probably you trying to force it. So like this. I mean, this is very clear, very easy, draw it on, and now I'm just watching to see what happens. Do sellers break below, or are buyers going to take back over and start pushing up to the previous highs? We'll see. I'm not trying to predict it, I'm just going to react. Now, this is a perfect example of a trend here. Now, trends, as we were talking about, often have a higher high and a higher low, which is very, very normal. It's sort of, trading, again, it's sort of trading 101. So we have the low here, we come up and create a high. We create the higher low, we come up and create a higher high, higher low, higher high, higher low, higher high. But the problem is, do you see how it's not perfect? So we've got, lows here. Would this have been the low? Would this have been a low? And I just ignored it. So, this is what I mean. Trading, a technical analysis specifically, is very discretional. So generally, what I would like to do, if I'm not super clear, I would pull up an area chart and I would say, okay, there's quite very clearly a low here. We've come up, created highs, low, high. So that's what I mean by I like to use an area chart sometimes just to simplify the market. I don't need to over-analyze things. There's no need to do that. So again, low, high, low, high, low, high. So very, very simple uptrend here. Now, the next thing I want to discuss here is something you will see in examples everywhere because it's so easy to explain and it's so easy to display that it's sort of just, that's the example. But the real problem is that trends very rarely actually are that easy. So you might get something more like this. So we've got the low and we've got the higher high. We've got the higher low, we've got a higher high. But the problem comes here, actually we created a higher low here. But this high is now a resistance, actually a triple resistance here. We've hit this level 3 times. Then we create a support here. So this is now a range, then we come down and create a lower low. So this is something that you would look at and say, okay, well, this isn't trending to the upside. But if you didn't think this was going higher, you would have lost money not buying the market. So this is what I mean by technical analysis is good, but it's not something I would ever use just for a trade idea. It's something I would use as a confluence along with the economics. But again, that's more advanced. We'll go into that in the future. But we can see that this market is very clearly going higher. And we do have this orange line here, which is a moving average, which again, we'll discuss in a future episode when I start going into my trading strategy a little bit more in depth. But I've just noticed this is another great example of candlestick behavior. So we had a very, very strong buyer's candle right here. We can see obviously the white candles obviously would have been green, the bullish candles out. This is my personal chart theme, so it's a little bit different. These hollow candles or these sort of transparent candles are bearish candles with sellers. So we can see, let me just pull my arrow up. It's just a little bit easier to show you here. So buyers came up all the way up here, or all the way up here. Then we had sellers in this candle. So we saw the buyers take over at this point, still continue higher. Then sellers came in and saw this candle or this wick rejection to the upside, and the candle closed bearish. So now we see the same thing here. Buyers tried to take over, push this candle higher. Then sellers were like, no, we're going lower, took over, and we created a really strong bearish candle. So we could see that and we could sort of dissect that and say, okay, buyers are losing control. It's twice that they tried to buy higher and failed, and the candle came lower by sellers. So we can see a very similar thing here where price came down to the previous low, created this sort of support, and we just couldn't get lower. So we can see the wick down, wick down, wick down, wicks down, wicks down, wick down here. The sellers could not push lower. Buyers kept taking over. So again, this isn't something I would base trades on alone, but it's still something you can use as a confluence. You can say, okay, I quite like that idea. What else is there out there to back up this idea that I've got? And again, you can see the same thing here. All these wicks to the upside, and the buyers just couldn't take over, and then we ended up selling to the downside. So that is trading 101. So we've discussed trends, we've discussed candlesticks, and we've discussed structure. Now, because those things are so almost rudimentary, and I don't mean that in a rude way, if you haven't understood that, it's completely fine. You can drop a comment in obviously on the video. I'm more than happy to answer it, or we could even dive deeper into it in another video if that's something you would like. But this stuff is very, very simple. There isn't any need to try and overcomplicate it. I would now suggest you to go onto TradingView. Again, we spoke about this, but TradingView is free. There are paid versions, but you can use it for free. So go onto it and just draw things up. Have fun. Add things. So one thing that we'll actually discuss in a second, but yeah, just have fun. Go onto indicators here. Throw on everything you want to do. If you're not enjoying this process and you're not just experimenting with everything, you're doing it wrong. Now, there is a limit to that. Obviously, when you start trading properly and you really start trying to make money from this, you have to have a plan. You cannot just be having fun with the market. That's not how it works. But to just start out, just to get familiar with things, to find out what works for you, just do it. Just go crazy. Add all the indicators, draw up boxes wherever you want to do it. Make some drawings, add some arrows, just do stuff. And eventually you'll say, oh, that worked quite well, actually. I like that. Or this was garbage. I'm not using that again. And you'll start liking things. You'll start becoming accustomed to the way the markets work. That will come after time, but you can start building it now. So final things are, don't trade yet. As I said, go and have some fun. Enjoy the learning process. Please don't put money on the line just yet. You will... I guarantee you will lose it, so don't bother. Open a demo account if you want to, but yeah, just watch the markets, draw some things up, and get a feel for it. Zoom out before zooming in. As we said, we would want to look more into different time frames for that. We might do that in the next video, but again, that will come anyway when I tell you about my strategy. But yeah, we would want to use higher time frames for what we call a top-down analysis. Focus on clean charts, but again, that's more when you get a little bit more serious about your learning. If you are very, very new still, again, have fun. Just don't follow the rules. Have fun, enjoy the process. And then when you find something, then start stripping back and trying to simplify it, and cleaner charts are generally better. It's less distracting and it's less things to cloud your judgment. And then again, practice making highs and lows, practice marking up trends and zones, and just... yeah, take what I've learned and try to apply it, try and test it and see what success you have. Guys, that concludes our third episode. I appreciate you watching. Again, we'll be continuing this series for the foreseeable future. But yeah, I will be seeing you all very, very soon. Please like and subscribe. You can join our Discord 7 days completely free. I will see you all very soon. Trade safe, and thank you for watching.